You guys hear me okay? Good deal. Okay. Excuse me. Let's see. You guys have a couple questions or observations. Roberto, noise and randomness sound similar but are very different? Question mark. I think noise happens and plays a part in determining shaping value. Randomness has nothing to do with value. It's different. Well, yes and no. The noise in the market is predictable and it serves a purpose. And the noise includes, from your perspective, an inability to predict the next price outside of the realm of randomness. But it's really quite orderly in that trade is being facilitated by buyers and sellers, and that's the purpose of the market. And it's random, it's noise, it's not tradable. So we're probably into semantics a little bit. I think that what's important is to understand that, excuse me, in general, the point about noise is that most of trading activity, especially in the intraday time frame, is noise, and that there is no edge, there is no positive expectancy trading just anywhere within a given auction range or a given time frame or a given intraday range. There are only certain areas, excuse me, and only certain times you have an edge. And what you're trying to do with your trading is to be aware of where the noise is, what noise is, and to avoid it, and to trade at those times where things are more likely to occur that are outside a random movement that occurs in noise. And here's the example of that. The reason you want to trade from these inflection points is because the move away from inflection point is more likely to be directional and sharper and with a greater range than is typical than you have inside near the midpoint of a day's range inside, say, a high volume node. The next 2 or 3 ticks when you're near the high volume node or at the high volume node are just as likely to be up in reverse or down in reverse as they are to continue. If you're at one of the extremes and a move begins, there's a higher probability that will be a move of sustained degree that's tradable and has enough potential reward in it to justify the amount of risk exposure of the trade. Okay, Giampolo, on the P structure, we should trade the P balance in the direction of the bigger time frame if the bigger time frame is vertical. Yes, Giampolo, in general, what you're trying to do is to identify the migration of value. And you can only identify value in an auction in a given time frame, and that value is that high volume node. And if those high volume nodes are generally moving higher, the trend is up. If the high volume nodes are generally moving lower, the trend is down. So in a smaller degree of time than the time frame, than the trend of the intermediate degree time frame, if you have a balance area in that time frame, it is advisable, really, to lean in the direction of the greater trend. And that should be one of the precepts of, that's a very good precept for anyone's trade plan. I'm going to identify small degree balance areas and then trade them. My tactics will be to enter trades using that smaller degree time frame, but in the direction of the larger degree time frame, as defined by the migration of value. And we'll look at some examples of that. Excuse me. Okay. Okay, you guys see my screen says bottom line, Holy Grail. Now it says the profile graphic. Okay, we're going to spend some time, a little bit of time now, going through some of the minutia of the profile graph. And this is probably going to pertain more to you very new people. This is something, though, that you do need to understand this. So if you don't, stop me and tell me. I'm going to go through this relatively quickly. Okay, this is, essentially each letter, this is a day time frame. Okay, this is 1 day's trade session in the S&P mini contract. I have it split here. This is when it's collapsed. And basically what this is, this view, this is a 30-minute bar chart, except instead of vertical solid lines, each 30-minute period is denoted by a letter specific to that period. So B in my NCQG, and in a lot of your software, this will be A. It's just B in mine because that's the setting. I could make it A if I wanted to. But B is the period from 9 o'clock to 9:30, C from 9:30 to 10, etc. Now P is from 4 to 4:15 because the futures trade for 15 minutes after the cash market closes. And this is what it looks like when it's split apart. This is the view that you get when it's collapsed. And it's this view that gives you the horizontal view of market activity. This is the traditional market profile view of a day session in the S&P mini contract. And over time, what happens when the day is complete, you can see on this day, you had your unfair highs up here, you had unfair lows down here, and then you had your greatest amount of trading in this area here. Now, you need to understand that these letters were the initial concept of Stottlemyre, and he calls them TPOs. And in Stottlemyre's terminology, it's time, price, opportunity. And that gets into some esoteric stuff, why he called it time, price, opportunity. But it basically, it's a record of a transaction at a given point in time. Don Jones refers to them as that price occurred, which I think is more direct and actually more accurate. So what happens here, when the market begins trading at 9:30, every time a new price is hit, it will print a B. Now, if a price like this is 903, if the market hits, trades at 903 a bunch of times between 9:30 and 10, it's only going to print one B. So in each given time frame, the market will print the letter designated for that time frame as long as the market's trading in that time frame, but only once. Okay? Now, I can make, and you saw me do this, I can make this a profile that takes the 30-minute data and collapses it into I can take this 30-minute period and make it a profile that would look like this, but it would be a 30-minute period. And I can break it down from that into 5 minutes. I can break it down into 1 minute. I can take this and I can go up the time frame, and B could be 1 day. B can be 1 week. It can be a quarter. It can be a year. So, but it's the same protocol for organizing the data, regardless of the time frame that you set. I hope I didn't confuse anyone there. Okay, now we're going to talk about, this is traditional, and this is, what you're seeing now is market profile stuff. It's really not auction market stuff. It's market profile stuff. And it's important because you need to understand going forward when you hear people refer to this stuff, and you'll hear it a lot, then you will have seen it here, you'll understand it from our perspective, and you'll know what's valid and what's not. But you'll also understand the initial basis for that. And most people that use this stuff don't have a clue. Now, these are the components of a given day. You had an initial balance period, and then you had a value area, and then you had TPOs. TPOs are the letters. Now, the initial balance period concept is a very important concept, was a very important concept in Stottlemyre's work. And the reason for the initial balance period, it was thought that, and if you think about it, it makes sense. Now, remember, this was posited by Stottlemyre, and its genesis was his vision from his view of the floor and the activity on the floor. And what he found was, what he observed, was that when the market would begin trading, the market makers, the floor traders, would establish a range. And the market would go higher and it would go lower, and there'd be trading within that range. Now, remember, the market makers have an edge. They didn't have to pay the bid-ask spread, and they were floor members, and if they paid commissions, it was de minimis. So they didn't have the transaction cost. The price could stay in a really narrow range, and they could just mint money. There was no incentive for the floor traders to move the market directionally, even if they could. There's no incentive for them to do it. They could sit there or stand there and make as much money as they cared to make, and actually it was safer because they could keep the market in a nice range, and they tended to do that. So what Stottlemyre noticed was that if after a certain period of time the market moved outside that range, it was because there were orders coming from outside the pit. So you basically had two time frames involved. You had the time frame of the floor, and they tended to keep the market in a range. And then if the market outside of a certain time period, and Stottlemyre just sort of arbitrarily chose the first hour of trading, that was just from anecdotal observation. If the market moved outside that range established in the first hour, it was assumed that it was another time frame trader. And that's where that time frame stuff comes in that you may still hear about. So it was an other time frame trader, meaning it was big money coming in. And so the market would have to go outside the initial range because it was being overwhelmed on a relative basis by buyers coming into the market, and the market would move higher, or sellers coming into the market, and the market would lose lower, to find an equilibrium where the business could be conducted. And it was further assumed that if the market broke outside that range, that it would define the type of day going forward. And initially, Stottlemyre had 4 day types, and that got expanded by Galton, and I don't know. We're going to go through the traditional day types in a minute. It might be 7 day types. And so basically what happened after the first hour of trading would enable Stottlemyre to label the day type. Now, you couldn't really label it until the day was over, but that's where the day type thing came from. It's what happened following the initial balance period. Hold on, T-bone, let's see. So we'll come back to that, Trevor. So your initial balance period was, and again, this was posited when the markets were relatively chronologically constrained. You know, one of Stottlemyre's concepts that nobody understood at the time was that the markets were moving from a marketplace orientation to a market orientation. In other words, back in the day when Stottlemyre was trading in the 50s, 60s, 70s, the trading was basically confined to floor trading hours. Well, now it's not. Markets are 24 hours now. I mean, the futures, for instance, even the stock index futures in the U.S., they shut down for 15 minutes a week until Friday, and then they open up again Sunday night. And so this initial balance period held more validity then than it does now for a number of different reasons. I'm just trying to give you the history of it so you'll understand when you hear some of the nonsense out there, you'll understand why it's nonsense, and it is nonsense. Now, I'm going to get into how some work that I have done on this initial balance period that pertains just to stocks that can be helpful. But I want you to understand the day type thing was derived from what happened following the initial balance period. And in one of Stettlemeyer's books, he actually uses a go with green approach or a red approach. So, I make fun of red light, green light. Well, ironically, Stettlemeyer initially posited this as somewhat of a red light, green light approach. If the market went outside the initial balance period, you went with it, green, So, sort of interesting. Now, the value area is the area in which 70% of the trading has occurred. And the value area is dynamic until the session in which your measuring value is complete. And it's a rather nebulous concept, and it obviously changes during the day. If the range extends and volume reaches new levels, the value area is going to migrate up or the value area is going to migrate down. Now, one of the rote trades that is posited by Dalton in Mind Over Markets, and I don't know, he may still do this, but he'll say, okay, now if a market, like if this market gaps up the next day and it trades 2 ticks into the value area, there's an 80% chance it's going to retrace the entire range. That's bunk. That's absolutely, there's no validity to that whatsoever. The value area is too wide generally to derive any particular information that you wouldn't be able to discern if you didn't have that blue line there. What we do, we tend to define it closer to an area nearest the highest TPO count. And there is a very high correlation between TPO count, in other words, the number of TPOs across the horizontal scale, and actual volume. The longer the time frame, meaning 2, 3, 4 days, the higher the correlation. Sometimes in the intraday time frame, you'll have a high volume node with a high TPO count, but you'll have higher volume on either side of it. And that's sort of an anomaly. I have not been able to discern any particular value in knowing that it's different in a given day, frankly. Daniel, this is funny. Daniel says, I feel like all my bubbles are going to get burst today. Everything I thought I knew about market profile is getting whacked. Well, Daniel, maybe I'm wrong. Prove me wrong. Like I said before, maybe they're all right and we're wrong, but I don't think so. The point of this is that a lot of the concepts that people coming into quote-unquote market profile are being exposed to are legacy concepts. They were derived in an area, in a point in time that is extremely different than today. So some of these concepts were valid 35 years ago, but are no longer valid today because of changes in the market. And some of these concepts were never valid to begin with, and you need to understand that. Okay, now I'm gonna run through the day type thing, and this is in the manuals you'll be getting. I'm not going to spend a whole lot of time on this. Normal variation day is the most common day, and if you think about it, it makes sense that it would be. A normal variation day is a day that extends outside the initial balance period in one direction only and is heavily skewed towards rotation as opposed to trending. And it's the most common type of day. And it's logical. Why would this be the most common type of day? Well, it's the day that is most efficient at facilitating trade, if you think about it. So you've got, this is a normal variation day. and it's a normal variation day to the upside because it extends outside the initial bounce period in one direction. A neutral day is a day that extends both above and below the initial balance period at some point during the day. This happens about 30% of the time. Double distribution day is a day that you've got two distinct balance areas that form separated by an area of single prints or few TPOs. Daniel, we're going to, all right, hold on. I read that normal days are misnomers and are infrequent. Yes, normal days are misnomers. I've been saying that for years. This is a normal day is actually an unusual day because you've got very little, if any, extension outside the initial balance period. Normal days are very rare in the stock indices. Non-trend days and normal days are essentially the same thing. You know, what happens 2 or 3 ticks outside the initial balance period? If you try to make too much of it, you quickly fall into the category of trying to make magic out of something that isn't magic. You know, you can only go so far with chronologically constraining market activity and trying to label it based on that particular definition of time, or that particular constraint of time. And that's one of the big differences between what the Dalton Stottlemyre early school. Now Stottlemyre's moved on. I don't think Dalton has. And what Don Jones does and what we do. Now trend day, the traditional market profile definition of a trend day is a day that opens near one extreme and closes near the other, and if it's rotational in a relatively narrow range. And by that definition, trend days are relatively rare. Now, this is what's useful about all this day type stuff. What's useful about it is understanding that if you think about it logically, the day types are just an extension of the underlying auction market process that we talked about this morning. You know, the purpose of the market is to facilitate trade. It's a probing process. You know, the market will establish a range. Most of the time, the market is not out of balance or trending vertically. Most of the time, it's in horizontal development. All of those things make sense. And trying to label every single day into certain parameters is really, you know, you're sort of becoming like the Elliott Wave people that want to, you know, come up with all these convoluted, well, it's a quadruple double zigzag that has you know, divided, you know, ABCX, ABCY, ABCX, you know, converging, diverging, triangle. You know, you just make stuff up as you, eventually you end up making up stuff as you go. Off track. You know, the point here is to be able to consistently and objectively define an edge. And when you uh-oh, crap. Hello? I don't know if y'all heard me. My power just went out. God, that's typical. Hello?
Yeah, Tom, you're fine. You running on battery? Still there, Tom? I don't hear Tom. Everybody hear me? I'm going to call him on his cell phone, see if I can find him. Yeah, guys, Tom lost his power. He's waiting to see if it comes back. Otherwise, I'm going to take a little break. And he said he can continue it from his notebook at home if he has to. But we'll see what's going on. Let me just take the host back from him. So in case we lose him completely, that won't be we won't lose the session. Let me go find the host key, guys. Just take me a sec. Okay, good. This way we won't lose anything. Yeah, while Tom's reorganizing, does anybody have any questions about anything? I know here in lovely New York, we're still getting organized from the snow. I just had a bunch of people here shoveling. We're running out of places to put it. By the way, guys, I don't know if you put the pieces together, but when Tom was talking about the classic definition of a trend day, that's exactly what we had on Friday in the stock indices. You know, very, very narrow balances, and we closed right on the low. So open near the high, closed on the low. So Daniel, there's a couple of things. First of all, the market does what the market does, and the market model that we're describing here is, to me, the most logical I've ever found, and it seems to work. So that's the main thing, is that it's tradable. In terms of fibs, I can tell you that there has been the scientific statistical research done that shows that they're just random. I think you'll find that any number that's just calculated, based upon swing points in the market, is going to have very little validity from the standpoint of an edge. Remember that anything that's random can't have an edge. Things have to move away from random. They either have to be inversely correlated or directly correlated in some way in order for them to have an edge. So anything that can be shown to be statistically random, that's the opposite of an edge. And I can show you what happens, mathematically, but it gets a little complicated. But basically, when things don't have an edge, what you're going to get is basically wider and wider swings around zero. And that's the reason that people that don't have an edge eventually go broke, even if they're decent traders, because it's very unlikely that their skill in whatever they do can overcome the overhead of trading. Just 1 second, guys. That must be Tom. Okay, guys. Tom is relocating to home, and he will be back up in about 10 minutes. So anyway, what I was saying is that what ends up happening is when you're dealing with any technique that's basically random in nature and can't be shown to vary from randomness, what ends up happening is that if you try to trade it, it's even if you have other skill and you getting other little tiny edges from other things, it's very hard for that to overcome the innate disadvantage in trading that comes from the overheads, because there are significant overheads in trading, which I won't go into right now. So what ends up happening is that you vary in a wider and wider range around zero and eventually run out of money. Now, yeah. Yeah, Daniel says something here. Daniel, you have to understand is that from a psychological standpoint, humans are very, very susceptible to selective perception. Now, do you know what selective perception is? Anybody? I'll explain it just in case anybody here doesn't know. Selective perception is when, and I'll give an example. Let's say that somebody has a good day in the market and they notice that there's a full moon. Well, there'll be a tendency for that person to believe that the full moon was the cause of them having a good day in the market. And every time they see every time that there's a full moon and they have a good day in the market, they will reinforce it. It'll reinforce it. There's a full moon again, and I had another good day in the market. The problem is they're not noticing every single time there's a full moon and noticing all the times that the full moon correlates with not having a good day in the market. And the same thing happens in trading. So you'll notice that, well, there's a high volume node and the 200-day moving average went right through it, or the 50% fib went right through it, or the 78% fib went right through it, and therefore, there's a correlation there. That must have made it stronger. But the problem is that unless you statistically analyze every single test of that fib and see what happens, you don't really know whether it added anything. It might just be pure coincidence. And that's what happens is that humans are very susceptible about basically taking random things and trying to put meaning to them, trying to find patterns in randomness, because our brains are constructed to find patterns. And we'll continue to try to find patterns even if the situation's random. I'm going to get into this a little bit more tomorrow because it has something to do with some of the stuff I'm going to talk about. But so just because something happens and it matches up on one particular instance doesn't prove anything. Just like just like taking one technique and getting one winning trade or two winning trades or five winning trades doesn't prove anything. The only way you can prove anything is by watching what happens over a reasonable amount of time and a decent sample of trades. Okay, does that make sense to you, Daniel? But I've seen enough stuff to not use fibs anymore. I don't even draw them. And I used to be a big fan of fibs. I spent a lot of time studying Carolyn Borden's stuff and Robert Miner's stuff, and I used to do fib clusters and fib extensions and fib projections. I can't tell you how much money I lost doing Gartley patterns. But we all have our painful trading experience. But it doesn't surprise me at all that there's no validity in any of that stuff. And like I said, just because it works sometimes and it appears to work doesn't make it valid. It's the same thing with floor pivots. Floor pivots look like they work sometimes also, and a lot of people swear by them. But the problem is if you just traded based on floor pivots, you would lose money because there's no edge there. Guys, I'll be there. One sec. Okay, guys. According to Tom, most of Savannah has lost power. So he doesn't have any power at home either. So what I want you to do is stay signed in for the next hour. If power comes back in Savannah, we'll continue today. Otherwise, what we're going to do is what we'll do is we'll continue tomorrow morning, and whatever we don't finish tomorrow, we will conclude on Monday evening after the market. And don't worry if you can't make it Monday evening, because we're recording everything anyway, and we'll make sure everybody's questions get answered. But there are some problems that you can't avoid, and it's unfortunate. I don't have all Tom's materials, otherwise I could sort of do the afternoon. But that's sort of where we stand. Anyway, are there any other questions that you guys have? While I'm still here. Oh yeah. Basically, what will happen is that when we actually end today's session, the recording of today's session will be available. And what we're going to do is we'll stay signed in, but listen to stuff, because if Tom comes back, he comes back. But I'm not all that hopeful of all of Savannah when the power in the whole state and the whole city went out. Gianpaolo, if you have an HVN based on volume and a different one based on TPO, I take, and I know that other guys here that are experienced traders will tell you the same thing. If it's confusing, don't trade. There are enough opportunities that are bell ringing clear that you don't, and what happens to most traders is that they're so anxious to trade all the time, and they think it's their job and they've got to be trading, that they sort of force things. And you got to learn how not to force things and only trade the things that are bell ringing clear. And we've had a few of those in the last few weeks. We had a situation in gold a couple of days ago where it was very obvious you had to take a trade. We had a situation in the euro last week where it was very obvious you had to take a trade. There are, and I'm going to go into some of that. I'll go into that when I do my thing tomorrow. Basically, the guys, what I'm going to do tomorrow is I'm going to give it about an hour, a little over an hour talk about the idea of when you should get aggressive and when you shouldn't be, from a proper standpoint, and contrast that with what traders usually do and how traders usually decide whether to be aggressive or when to pull back. Okay, so and also I want to teach you guys something about a little bit about the proper way to use probability. So, bunch of good stuff coming. Okay, so anyway, let's give it an hour, and we'll see if we can get this session going again today. But otherwise, the backup plan is that we we'll continue tomorrow morning, and whatever we don't finish, we will conclude on Monday evening. Yeah, Daniel. Tomorrow, what Tom usually does tomorrow morning, and I'm not sure how the schedule is going to be now, is he goes through lots of exercises on real trades of the past, and you get to decide what you would do and whether you'd go long or short. We don't actually do replay as such, but we come as close as we can. So there's lots more to come. Yeah, sure, Michael. Email me whatever you have. I'm always interested in anything like that. With better ways to use Delta. Yeah, I know. I hate when we lose power here. I'm surprised we didn't lose power. We still got, we had so much ice and snow laying on top of trees. I was sure that we would. See, it's too bad Tom doesn't have power at home, because what he can do is he can sign onto his AT workstation from his notebook and sort of run his presentation from there. It's one of the nice things about AT workstations. Any of you guys that don't have AT workstations should consider them for situations like this. You know, they really give you a lot more flexibility in being able to stay up when other people aren't. Yeah, Daniel. Well, it's interesting. It was the same thing for me when I first came to this, and you have to understand this is that a lot of the stuff that well, first of all, some of the stuff in trading goes back 100 years, and some of it never had validity in the first place. But no, hold on, I got Tom back again. Okay, guys, I got good news for you. The power is back on in Savannah, and Tom is on his way back to the office, so he'll be back in 5 minutes. So we should be able to continue in about 10 minutes. Anyway, what I'm saying is that a lot of stuff, was never valid in the first place. Yeah, and then there's other stuff that, like Tom said, is based upon the fact that we used to have a very important day session and a very unimportant night session, and that everything was based on the pit. In various markets. And you can see other markets. I mean, look at, to give you an example, think about currencies for a second. When I traded currencies in the 90s, I was trading currency futures because that was the only thing you could trade. And the currency futures were pit-based also, very active pit in currencies. And, the currencies pits would open, close at 3 o'clock. And then they didn't even have Globex, and then all of a sudden, then they had Globex, and then you'd have, light volumes in the overnight, and then all of a sudden you get into the 2000s, and they've got Cash Forex. Everybody's got a Cash Forex account, so things change. But the thing to understand is that just because lots of other people do something and people write books about it, doesn't make it valid. Just understand that. And when Tom talks about magic, that's very important too. Understand that if magic did exist, they wouldn't be telling you about it. They'd be trading it. We teach this stuff because it's discretionary. And by us teaching it to you, it doesn't hurt our ability to do it because everybody's going to do it differently. There's, even though Tom and I see the same areas, it's like he said the other day, I went long the euro. He went short the euro. But we both took a trade that had an edge. So we can teach this to lots and lots of people, and it doesn't make it not work. It's so funny. Same thing happened in gold, by the way. Gold got to this great trade location, and I went short, and lots of people in the advanced rooms went long. But then sometimes I go on cold streaks, and they go on hot streaks. So there's no rhyme or reason to it. But gold is still going to be good trading next week, by the way, and so is the euro. British pound too. British pound has been making a balance for the last 3 months, and it's starting to get mature. So I have a feeling that there's some good British pound trade coming. We'll go through a lot of that stuff tomorrow night. Towards the end, we'll do a review of all the markets, and we'll start setting things up for Sunday night and Monday. Anybody else have any other questions? Yeah, by the way, there's another thing that I've noticed that it's funny we have discussions about stuff. If you notice, Goldman Sachs and a couple of other banks 2 quarters ago had these streaks where they had them for a few quarters where they had no losing days, because of this high frequency trading they were doing, and they were just coining money with high frequency trading, never losing day because basically they were front running. At any rate, now you have so many people doing high frequency trading that the edge in high frequency trading is rapidly disappearing. And you notice Goldman Sachs doesn't have that anymore. See, all the banks are missing earnings this quarter because their high frequency trading edges are disappearing. And that's what happens. You know, if something has an edge and everybody starts to do it, you know, in mass because it's computer based and they can figure it out, the edge doesn't last. It just disappears. Anyway, Tom should be back in a couple of minutes. I'm glad his computer never went down because I can see his screen sharing still there. So his UPS kept him up. I doubt it. I doubt it, Skip. Because it's not computerized. You know, I think that at some point, you know, if we end up having computers that can actually think like people, it could disappear. You know, because then, you know, but I think I don't know if that's going to happen in our lifetime. We'll see. You know, we'll see. They're having the big thing with Watson on Jeopardy in a few days. Of course, that software is not going to appear on anybody's desk anytime soon. But there's so much involved in the thought process and how you analyze situations, what time frames to look at, what's most important. You know, which structures are most important. It can get complex, but you know, it's obviously doable because lots of people have been able to learn to do it. But it's not something that's and yeah, and like Daniel says, emotion too. It's not something that, and believe me, I'm sorry, I'm babbling a little bit, but believe me, I know how to computerize stuff. If there's a way to computerize something, I figure it out. I sort of hone in on those things. And Tom and Doug and Don Jones have been asking me to computerize stuff and make magic out of it for the last year. And you notice the only thing I'm working on is EdgeCalc and trade logs because I know that it's pointless. There's no way to computerize it. You're right, exactly, Skip. Judgment is required. No, the interesting thing about the Jeopardy thing is that IBM has a computer that can interpret the language. You know, just take a normal Jeopardy question and know what to look up. Yeah, obviously the answer is knowledge, but it's a matter of interpreting a computer being able to interpret the language. That's a very big step. You know, complicated inferences. Anyway, guys, Tom should be back in a minute, so I just got to take a break for a second.